If you've been watching the job market lately, it can feel like the world is running on two completely different rulebooks.
Productivity of American workers nearly doubled in the 30 years after World War II, and so did hourly wages. This helped build the American middle class. But things didn't stay that way. Productivity kept rising, but wages flatlined.
On one page, companies talk about efficiency. They talk about automation. They talk about AI tools that can do in minutes what used to take a team all week. They talk about cost cutting like it's a medical procedure, painful, necessary, and strangely noble. And then right after the layoffs, the headlines hit.
Tesla CEO Elon Musk was just awarded the biggest CEO package ever with a potential value of $1 trillion. Musk is already worth more than $650 billion following the release of that 2018 pay package after a lengthy legal battle in a Delaware court. This new pay package could make him the world's first trillionaire.
Executive pay packages worth tens of millions. Sometimes more, sometimes a lot more. So people ask the obvious question, if AI is taking jobs, why are CEOs still making millions? The first answer is uncomfortable because it's simple. Most CEO pay isn't really pay the way normal people think of pay.
Buybacks began in an era when less than 1% of America's population held nearly a quarter of its wealth. Today, buybacks are back, and the American economy looks a lot like it did in the 1920s.
A typical worker gets money for hours, output, reliability, or specialized skills. A CEO's biggest payday usually comes from ownership-style rewards, stock awards, stock options, and bonuses tied to financial targets.
The economy works well when the stock market does well.
Wrong.
But a big reason stocks rise in value and don't fall as far as they would otherwise is stock buybacks. For years, corporations have spent most of their profits on buying back their own shares of stock, instead of increasing the wages of their employees, whose hard work creates these profits.
In other words, the CEO isn't compensated mainly for work performed. They're compensated for what the stock price does and for hitting numbers that investors watch. That difference changes everything. That's why the gap got so extreme. Economic Policy Institute has tracked CEO compensation for decades.
In 2022, the average CEO to median worker pay ratio is 235 to 1, up from 212 to 1 in 2020. Average CEO pay jumped 31% in the last 3 years, while median worker pay gained 11%.
Their long-running finding is that CEO compensation has grown dramatically since the late 1970s, while typical worker pay has moved much more slowly. One widely cited EPI estimate shows CEO pay rising by more than 1,300% since 1978, while typical worker compensation rose far less over the same period. And newer EPI updates keep the same basic story. The ratio between CEO and typical worker compensation has ballooned compared to the late 1970s. Now here's the twist that makes the AI question make sense. CEO pay can surge even when the company isn't getting better in any human, everyday way. Because a CEO can win financially through the market scoreboard, not the workplace's lived reality. Imagine two elevators in the same building. Workers are in the slow elevator, climbing one floor at a time. CEOs are in the express elevator that's wired directly to the stock market. When the market rises, the express elevator jumps. When the company announces a plan Wall Street likes, it jumps again. When interest rates shift, when a trend goes viral, when a competitor stumbles, when an entire sector gets hot, it jumps again. This is why you can see a year where the company feels the same, or worse, for employees. But the top still cashes out like it was a miracle season. Even mainstream reporting has emphasized how big modern CEO packages are. For example, surveys cited by the Associated Press found median CEO pay packages around the $17 million range in recent years, with typical worker pay nowhere near that neighborhood. So the why starts to come into focus. Modern CEO pay is designed to follow financial outcomes, not workplace outcomes. And once you understand that, you start seeing the machinery behind it. One part of the machine is the performance metric game. A huge amount of executive compensation is tied to a handful of metrics that sound technical, but are easy to manipulate in spirit. Earnings per share, total shareholder return, revenue targets, profit margins, and stock price performance over a period. Here's where it gets interesting. A company can improve earnings per share in more than one way. You can grow the business and earn more money, or you can reduce the number of shares the earnings are divided across. And that brings us to the quiet giant of CEO wealth, stock buybacks.
Stock buybacks are artificial efforts to interfere in the so-called free market to prop up stock prices. Because they create an artificial demand, they force stock prices above their natural level. With fewer shares in circulation, each remaining share is worth more.
Buybacks are when a company uses its cash to repurchase its own shares. When shares go down, each remaining share can represent a larger slice of the company. That can lift earnings per share and often supports the stock price. And when executive bonuses and equity awards are tied to those very metrics, buybacks can act like a lever. This link between repurchases and executive incentives has been studied and debated for years. Research and commentary summarized through Harvard Law School's Corporate Governance Forum highlights the ongoing focus on how buybacks interact with incentive compensation. So the AI era creates a new kind of pressure. Not just can we automate tasks, but can we tell a financial story investors will reward immediately? Layoffs, automation, and restructuring often come packaged as discipline. Wall Street sometimes responds positively because costs drop fast and earnings can look cleaner. Even if the long-term damage is real, the short-term score can sparkle. That's the logic of the system. Reward the scoreboard. Now let's talk about how the system gets approved. A lot of people assume shareholders decide CEO pay. Not exactly. CEO pay is typically proposed and approved by boards and their compensation committees. And yes, shareholders can vote on executive compensation at many public companies, but those votes are generally advisory. The USSEC has explicitly explained that say-on-pay votes are advisory rather than binding, and that the shareholder vote to approve executive compensation shall not be binding on the company or board. So even when investors vote no, it often functions like a loud warning sign, not a hard stop. It can pressure boards, it can embarrass leadership, it can reshape future packages, but it does not automatically cancel the pay plan. And that board dynamic matters, because boards often live in a world of peer comparisons. If Company A pays its CEO $15 million and Company B pays its CEO $20 million, a compensation committee can argue that paying $17 million is competitive, even if nothing about the job suddenly became 13% harder. This creates a ratchet effect. Each firm tries to pay above median to attract top talent, and the median rises because everyone is chasing it. Meanwhile, the worker side of the equation doesn't have that same ratchet. A worker's pay doesn't automatically rise because a competitor raised wages, especially if the worker doesn't have leverage, a union, or a hot labor market. This is also why the AI conversation feels so bizarre to normal people. AI changes what labor can demand. If tasks become easier to automate or outsource, wages get pressure. But CEO pay is tied to financial engineering, ownership incentives, and board culture. That structure can stay intact while the workforce underneath it is being redesigned. So when people say, if AI is taking jobs, why is the CEO richer than ever? The answer is, because the system rewards the CEO for the transformation itself. If the transformation makes the stock rise, the CEO wins. If the transformation reduces headcount and boosts margins, the CEO can win. If the transformation convinces investors the company is modern, lean, and AI first, the CEO can win. If the transformation convinces investors the company is modern, lean, and AI first, the CEO can win, even if the human cost is brutal. Now, is this performance? Sometimes CEOs do build real value. Sometimes leadership choices genuinely matter. But the world is complicated, and company outcomes are influenced by market cycles, interest rates, sector trends, and competitive forces. That's why it's hard to say a single person caused most of the result. This is one reason researchers keep debating how large the CEO effect really is, and why studies vary in estimates. For example, recent academic work continues to examine how much of firm performance variation can be attributed to CEOs versus other factors. So even if you believe CEOs matter, it's still reasonable to question whether pay packages should behave like lottery jackpots during broad bull markets, which leads to the final layer: what the economy is rewarding. In the last few decades, the economy has become more financialized, meaning corporate success is often measured less by long-term capability, like training workers, building durable products, or expanding capacity, and more by shorter-term returns to shareholders. When that's the scoreboard, the incentives follow, and that's why the AI era might widen the gap even more. AI can increase productivity, but who captures that productivity? If the gains show up as higher profits and higher stock prices, executives and shareholders capture a large slice. If the gains show up as lower labor costs, executives and shareholders capture a large slice. If the gains show up as faster output with the same staff, the benefit depends on bargaining power. Without leverage, workers might just get more work. So what changes the outcome? One alternative model is employee ownership, structures where workers share in the upside, not just the workload. The most common U.S. form is the ESOP, an employee stock ownership plan. The National Center for Employee Ownership reports thousands of ESOP companies in the U.S., with millions of participants and substantial assets held inside these plans. That doesn't mean ESOPs are magic, but they represent a different philosophy. If a company is going to run on ownership rewards, workers should have some ownership too. Because here's the core truth of this whole story: CEO pay didn't just rise, it was engineered to rise. Through stock-based incentives, board norms, and financial metrics that can be improved without improving life inside the company. And AI doesn't break that system. AI can supercharge it. AI can cut costs faster. AI can accelerate restructuring. AI can generate investor hype. AI can help deliver a narrative Wall Street rewards. So the CEO question is really a distribution question. Who benefits from productivity? Who benefits from automation? Who benefits from the future? And when people feel like the future is arriving, but only paying out at the top, it's not confusion, it's math. If you want to understand why CEOs keep making millions while workers worry about being replaced, don't start with personality. Start with incentives. Follow the money, follow the metrics, follow the stock price. Because in the modern corporate system, the CEO doesn't have to win at work to win financially. They just have to win on the scoreboard. If a company replaces jobs with AI, should workers automatically receive stock or profit sharing? Yes or no? At Machine Minds, your opinion matters to us, so please feel free to like, subscribe, and share your thoughts in the comments section below.